Hi there, this is Jason Coddington with Coddington Wealth Advisors, and this month on Student of the Market, we'll be focusing on how presidential elections have impacted the capital markets. And so we'll be looking at history over the past, many elections this century, and looking at, how those markets are impacted and what we can learn from it going forward. So, hope you enjoy this month's Student of the Market. All right, so this month of Student of the Market, we'll be looking at actually an election year. So how have markets performed in election years, presidential elections, and then non-presidential election years. So we'll be looking at that and kind of glean forward as we head into November of this year. So we'll take a look at it now. So first of all, most importantly is irrespective of who's in office, stocks have continued higher regardless of presidential party. So going back to 1926, stock market ended higher than when it started, with the exception of 1926 to 1930. So, but the key here is stay invested, and irrespective of who's in office, stocks continually move higher. If we were to look at stocks across the election cycle, so historically speaking, from 1926 to last year, 2019, average rate of return in stocks, 10.1%. In presidential election years, 11.3%. A little bit less in midterm elections at 8.6%. And then non-election years, where there's no midterm or presidential election, 14.3%. And, no real clear reason there other than perhaps maybe there's less headline news to hold markets back. 3, this one's important because investors typically build up cash in election years, and this is largely due because of uncertainty. And I'm sure this year is no exception. If you hear certain phrases like, oh, if he's elected, the market's going to go terrible, so I'm going to put all my money in cash. Well, if you couple that with COVID-19, you can see that in 2020, we have the largest amount of money in history in money funds. So you can see that $980 billion of flow into money market funds. So again, typically investors build up cash, but in the long run, it's always important to remember that staying invested is better than trying to time the market. Moving forward, so if we look back 1926 to 2019, same party has had where there's been the president and Congress have been the same party. That's happened 47 years, and there's been 47 years of divided government. So that's just an interesting fact. And if we look whether in a divided U.S. government, so when we have Congress that is a different representation than the presidency, then you will see that the 1 and 3 year returns right at 10%. If you also see, you'll look here to your right on this graph here where it says the same party, where the president, Senate, and the House are all the same. Also, the 3 year return right at 10.2%. So, interestingly enough, doesn't really matter from a capital markets perspective over a 3 year period of time whether it's the same party or a divided government, at least as history has shown. And then if we look at stocks across the presidential term, whether it's year 1, year 2, year 3, or year 4, you can see, and this is historical performance all the way back to 1926. And if we look 9.9%, 8.6%, and then amazingly in year 3, historically has been the best year, 18.5%, and then year 4, 11.3%. Just interesting how the stock market performs over time in presidential elections. And if we look, not much difference in presidential elections between the first term and second year term. The historical average, again, since 1926 through last year, 12% and 12.2% respectively. So one thing that comes up is, well, what about an incumbent president? If we keep the status quo going, should that be better or worse for the market? So we'll just take a look how what history has shown. So new president is elected, stocks typically an average return of 9.3, whereas bonds 6.7. If we look at all presidential election years, stocks 11.3 versus bonds at 5.5. But if the incumbent president wins, you can see that 13.4% increase in return versus 4.2% in bonds. So just some things to be considering, as we move forward into this presidential election. The other is market seasonality in election years. And so earlier in the year, we talked about this time frame called mommies to mummies, which is Mother's Day to Halloween. And so if we look from 1926 to last year, in all years, that period of time in an election year, 4.2% is the average. If we look in election years, 5.9%. In non-election years, 3.7%. So you can see mommies to mummies in all years. So Mother's Day to October in all years is 4.2%. And when you compare that over to what we call turkey to tax, or Thanksgiving to April, or November to April, you'll see that in all years 7.3%. So just an interesting fact, whether it's an election year or not, May to October, it typically underperforms basically November to April. So that's historically how the markets have turned out. In election years, looks pretty much very similar, 6% versus 5.9%, whether it's November to April or May to October. And then non-election years, of course, the November to April period of time there has historically done really well at 7.7%. So again, we're not telling you to get in the market in November through April and then get out in May through October, but we're just interesting to see that, we're heading into a period of time where historically the rate of return in the market has been higher. And with that being said, that concludes our student of the market for August of 2020, an election year historical look. And hope you found this information useful. And if you have any questions about how this could impact your portfolio, please don't hesitate to give us a call. Thank you so much. All right. That was Student of the Market for August of 2020. Hope you enjoyed it and learned some stuff about the presidential elections and how they can impact capital markets. If you have any questions about this and how it may impact your portfolio, investments, or financial goals, don't hesitate to give us a call. We look forward to seeing you next month.